Good morning and welcome to today's Five with Fitz. I'm Keith Fitz-Gerald. Thanks as always for joining me. All three averages are higher again as I record this, and one of these days there's going to be a short, sharp shakeout, but evidently not just yet. Cool beans as far as I'm concerned. Now, I know I sound like a broken record at times, but that is very, very deliberate on my part. Here's why. Most investors worry incessantly about everything that could go wrong, so they almost never get started and probably never achieve the results they want. But the world's best investors, on the other hand, constantly focus on what could go right. Then they invest accordingly, which is why I suggest you take a page out of their playbook. This isn't rocket science, folks. Buy the best, ignore the rest. Here's my playbook. Number one, how I pick stocks when I expect higher highs, earnings, and more. It was great to be back on the watch list with the super sharp Nicole Pedalides, who asked me what must happen in order for the S&P to hit my target, my year-end target of 7,000, and of course about earnings and more. We also spent a moment talking about how I select stocks, especially with the markets running higher in case that's of interest. And you can watch that elsewhere on my channel. The key point here is volatility, which I expect to increase, by the way, is an opportunity, not something to fear if you're doing your job right. So here's an investing tip in this department. Must-have stocks make must-have products the world can't live without. Nice-to-haves? Not so much. Don't ever confuse the two. Number two today, a new old dividend choice gets better. Most investors dramatically underestimate the impact dividends can have on your portfolio and on your financial well-being and on your wealth building. I, on the other hand, have no such illusions, and I'll be the first one to admit that I like my dividends. I'm kind of funny that way when it comes to cold, hard cash. Maybe you are too. Anyway, I tend to pay attention every time a good company gets better because of that. That's the case with T-Mobile, where subscriber acquisitions and additions are up, as is the average revenue per customer. That company has its sights on 12 million plus subscribers or customers, whatever you want to call them, by 2028. That's just 3 short years from now. Structurally, I also like the fact that the company has better 5G coverage than competitors. It's easily using excess network capacity to offer home internet via fixed wireless modems, which makes it an increasingly viable competitor to A, traditional internet service providers, and B, cell phone providers alike. Now, where it gets interesting to me is that the TSY, the true shareholder yield, a metric I look at very carefully when I'm selecting stocks, is 4% versus the 1.37% listed yield on most websites. So that's a plus too. Makes a big, I might have to think about that one. Anyway, number three, Intel. Oh my goodness. This may be a real life Manchurian candidate. I mean, U.S. President Donald Trump is calling for newly seated CEO Lip Bhutan's resignation, citing conflicts of interest concerns tied to China. Oh boy, serious stuff. I mean, this is no joke, right? There are reportedly connections to companies fronting for the People's Liberation Army, the PLA, and other concerning entities in China, whatever that means. Probably classified at this point. But there are also reported references to a past criminal case involving Cadence Design, where Tan was CEO, apparently, if my memory's correct. Um, Speaking personally, I have never been more glad to be out of and away from a stock than I have with Intel. I mean, this is starting to feel like a real life Manchurian candidate scenario, in case you're not familiar with the book or the movie. Except instead of covert mind control, what we're watching is a once great American tech icon potentially sleepwalk into strategic vulnerability, or, and I really hate to say this, go blindly and deliberately. Now, how low can Intel go? I don't know. I don't have any idea, but I'm thinking about buying shares. Think about that for a second. Don't call me crazy, right? I don't think it's a stretch to imagine Intel getting nationalized or some sort of strategic government investment a la MP Materials recently. Call options might do the trick nicely too. Now, at what price and how low will it go? That's unknown. And so you got to change up your game here. That's unknown because if a deal like that surfaces, it's probably going to come out of left field. So the question really is how to build a position using the right tactics, which is a completely different thought for most investors and traders who think in terms of dollars, right? Tactics are what's going to make the difference here. So one trade idea, one way to approach this is a series of progressive low-ball orders that helps control risk but yet gets you in the game. Or call options purchased as prices drop, volatility's down, and they're cheap. Either way, it could be very, very interesting play. So that's another in my book today. Number four, Lilly puts up the numbers. Should you buy it? I personally am delighted to see Eli Lilly hiking guidance and posting strong numbers. And I agree with CEO David Ricks, who said he felt good about the value of the company to CNBC. I simply prefer other pharma choices with what I think are higher, better, and more consistent profit potential, not to mention risk-adjusted upside. Lilly has declined its goes to roughly $600 billion in market cap, with investors betting heavily on GLP-1 and Alzheimer's breakthrough, both of which are very promising, but still largely unproven longer term. Meanwhile, my choice, the stock I prefer in this space, has absorbed a patent cliff, yet still delivered double-digit EPS growth and has an expanding, far bigger neuro-oncology pipeline, which I think, according to my research, has vastly better 0 to 1 upside. And not for nothing, it also has a materially better and far longer history of dividend increases and stability too. So, there's those dividend things again. Anyway, investing tip in this department. Investing is as much about what you own and why as what you don't and won't. And the sooner you know the difference, the sooner your portfolio can thank you. Now, many investors think they've got this covered, only to find out too late that they don't. And you're not alone if you're one of them. And I'll be here, of course, if you'd like a nudge in the right direction. But you got this. One way or the other, you'll figure it out. Number 5, finally, Peloton reminds me of GoPro. I mean, just wow. I was amazed when I saw the headline. Peloton and profit in the same sentence. I mean, I had to read the story several times to be sure my eyes weren't deceiving me. Peloton finally pulled off a surprise. Profitability. EPS came in at 5 cents, smashing the expected 6-cent loss. Revenue hit $607 million, also ahead of forecasts. That's a hard pivot from the $30.5 million loss, give or take, posted this time last year. And it's driven, of course, by aggressive cost cuts and slightly less terrible hardware sales. Now, there are some green shoots, to use a very overused phrase I can't stand. $320 million in free cash flow for the year. That's a genuine win, no matter how you cut it, how much fun I poke at the company. Gross margin was up to nearly 54%, 6 points higher year over year. Hardware gross margin is finally in the black at 17.3%, thanks to a better product mix and less bleeding from services. Operating expenses were down 20%, with marketing, R&D, and G&A trimmed, all of them. So, is it time to buy? For me, not a chance, because Peloton is still an N+1 company, to borrow a term from billionaire Peter Thiel, meaning that it's a business still tweaking the status quo. It's not inventing the future. There are literally dozens of exercise bike brands with very or little or no differentiation. So try as they might, odds are that Peloton will never have Palantir-like results, or NVIDIA-like stability, or Tesla's Dojo-like profit potential, all of which are truly 0 to 1 choices. Peloton, in fact, reminds me of GoPro, which traded at over $90 a share in 2014, and which I explicitly and repeatedly said avoid like the plague, by the way. GoPro closed yesterday at $1.31 a share, down 98.54% since then. Peloton is just pushing pedals. I'll pass, or buy Putskis, which is a bet the stock falls. But at $7, I can think of better, more compelling choices with my money. Anyway, today's bottom line, there is an entirely new generation of millionaires being printed right now. You, my friends, know what to do. As always, let's make it a great day. You got this, I promise, and I will see you tomorrow. Thanks for joining me.